Welcome to the Source of Commercial Real Estate, where we discuss all things commercial real estate, including finding and funding deals, seeking opportunities, and using commercial real estate to live the life that you want. I am your host, Jonathan Hayek, and today I'm talking with Elijah Brown. Elijah began his real estate career as an employee for a large real estate investment trust, Healthpeak Properties. During his time at Healthpeak, Elijah developed a strong foundation in financial modeling, playing a key role in $4 billion worth of transactions. In 2017, Elijah co-founded GoldHawk Capital, a real estate investment firm focused on acquiring value-add multifamily and Airbnb properties across the United States. Through a combination of ownership structures, Elijah has acquired an interest in over 1,000 apartment units and 100 short-term rentals valued at over $150 million. In addition to real estate, Elijah serves as a civil affairs officer in the United States Army Reserve and was previously a military intelligence officer. Elijah has received numerous leadership awards during his time in the military. Elijah received his bachelor's degree in business from the University of Southern California, and he is now traveling the world full-time in his self-converted camper van. Elijah, thank you for joining me. How are you today?
Jonathan, thank you so much for having me on. I'm doing well. I'm here in incredible Colorado on the western slope and just having a great time and really looking forward to our chat today.
Awesome. Well, we are going to get into where in the world you are and what you're doing and why you're doing that. But before we get there, why don't we start out with a little bit more about your background? I'm intrigued by your experience at Healthpeak Properties. So just give us a roundup kind of what your experience in real estate is and what you're focused on today.
Sure. Well, I began actually before I got the job. I was watching a lot of YouTube videos while I was in college and fell down a YouTube rabbit hole just watching all these different channels explaining how you're going to become wealthy if you invest in real estate, and I got hooked. And after weeks of watching those videos, I realized that I just needed to buy a rental property. I needed to somehow put the capital together to go out and put a down payment on a single family house and put a tenant in there. And the issue was I didn't really have any money. I didn't have any credit. I didn't have stable employment. I was a student. And so I gave my best friend and my cousin a call and somehow convinced those guys to jump in with me on this rental property. And so I got my started just buying a single family rental property in Orlando, Florida. I was going to school in Los Angeles and we bought a property all the way across the country in Florida, and we put a tenant in there and it was great. And we did that a few more times before I ended up getting the job. Fast forward a few years, I graduated from school. I ended up getting a job at the real estate investment trust at the REIT, and I learned a ton there. So they put me through an Excel modeling underwriting boot camp sort of thing where I would go for like an entire week online and watch videos and do interactive modeling and stuff like that. And then they put me to work actually cash flow modeling deals, different structures, specifically within the senior housing department. And so I got good at understanding inflows and outflows of cash and how those different inputs and those different deal factors result in specific rates of return and outcomes for the investor. And I really enjoyed that. And on nights and weekends, I started doing it for myself with multifamily properties. And so I went out into the vast marketplace and started looking for properties, negotiating, working with brokers, finding investors, working with banks. And I was able to put together a number of these small to mid-sized multifamily deals, just on weekends and nights, and working alongside getting some of my coworkers even to invest in those deals. And so that was pretty exciting. And then I realized that if I wanted to really scale the portfolio and kind of jump to that next level, I needed to stop doing everything. So up until this point, I was like literally finding the properties, finding the debt, finding the equity, finding the property manager, managing the manager, renovating these properties, doing like everything myself. And it was brutal. I was burned out, and I realized that I really needed to essentially partner with a larger company that was doing this on a much bigger scale, and I would essentially just bring the skills that I was good at to those deals. And so for me, that was underwriting, that was also investor relations. And so I started partnering up in a structure that we call co-GP, which essentially just means that I was joining those deals as one of the managers of the deal, as one of the operating partners involved in managing the deal. And so I did that for a lot of deals. And that's how essentially I was able to scale my holdings up to having interest in over 1,000 units. And since then, a bunch of the deals have gone full cycle. We've had 10 exits so far from the deals that we bought earlier on. And I've switched up my model a bit. So instead of actively participating in the operations and the management of the deals, now I'm more of a passive investor. I like to write checks for really good deals that are managed by really good sponsors. And I also raise money so that I can write bigger checks for those deals. And with those larger checks, I can usually negotiate with the sponsor of the deal to get some kind of better terms on the deal. So that is what my current business model is right now. That's what I'm focused on, and I'm looking forward to, getting another 1,000 units this year.
Cool. All right. Tons to go into there. I want to go into your current capital raising endeavors, but first I want to go back to your experience with Healthpeak Properties, the REIT, and the financial modeling. So I want to ask you for more of an explanation on what you mean by financial modeling. From what it sounds like to me, it seems like you're taking a property and you're looking at all of the inputs and you're projecting out 1, 3, 5, 10 years down the road, what kind of cash flow, what kind of returns this property is going to kick out to investors. Correct me where I'm wrong and fill in the gaps for me.
No, that's completely right. The whole point of the modeling is to help you make a decision based on risk. And so you have the opportunity to buy property A or property B or do nothing. And how do you know which one to do unless you can understand what the rate of return is and how much you're going to have to put into each one? And to do that, you need to calculate the cash flows that are going in and out of the deal. Some people call it a calculator. I call it an underwriting model. There's a lot of different names for it, and it's usually done in Microsoft Excel. And essentially, you're just taking all of the inputs, the variables, for example, like how much is the rent going to grow? How much money are you going to spend on renovations? What's the purchase price? You put all of these numbers into a spreadsheet, and then it kicks out a certain rate of return. And we have a lot of different metrics that we use to understand the risk. And that rate of return, or that metric, whatever it is, cash on cash, average annual return, whatever you're using, tells you, is this opportunity worth the amount of risk you're taking by buying it, essentially? And so it's extremely important, even for people who are just writing checks and not doing any management, to understand how the modeling works, how the cash flow works.
Yeah, makes a lot of sense. And it's something that is incredibly complicated because there are a lot of factors that go into a property, especially a multifamily property. If it's a REIT and, if they're going to be holding it for 10 years or something, there might be multiple evolutions of rehabs. You might go in there upon, first purchasing a property and put in vinyl plank, but you may find that vinyl plank really only lasts 6 to 8 years. So 9 years down the line, then you're doing flooring again. And, in 6 years from now, what are property taxes going to be? That kind of stuff is really, really complicated. Is it a proprietary model that you were using? Did you develop your own? Did you take a template and tweak it? Or how exactly does somebody develop an underwriting model?
So when I was working at the REIT, every situation, every deal was just completely different. I wasn't necessarily just doing acquisitions. I was doing like more complex deal structures that included like lease restructuring, acquisitions and dispositions at the same time, like trades and stuff like that. And so each model that I did really required me to essentially build it from scratch. And the model that I built, since I did it on company time, that belongs to the company. It's not something I could just share with you. But what I did create is my own multifamily underwriting model for value add properties that I actually offer for free on my website, goldhawk.us. And then I also have the link to that on my LinkedIn in the featured section. So you can go and download that for free if you'd like. It comes with a video tutorial and essentially just goes through the whole process of underwriting a multifamily property. But to answer your question, it can be extremely complex. The best models that I've seen are extremely simple, but still have the functionality needed to properly analyze the risk from every different angle. And it's just everything under the sun. And once you get out of a specific type of strategy and asset class, like each different asset class and strategy would have completely different underwriting, completely different modeling. And so there's really no one size fits all with the models. You kind of have to have a new model for each different situation, or adapt the model that you have to work.
Cool. Really interesting stuff. And it seems like you've really currently zeroed in on your two superpowers. So, one, underwriting, which we've just talked about. And the other one, which you talked about, was investor relations and capital raising. So, I want to spend the majority of our time talking about investor relations, capital raising, partnering with larger operators to do these deals. So, from what I understand, your business now is working with high net individuals, raising capital, and then partnering with large operators who have a system and an operation and deals, and you partner with them and you put your money into their deals as a limited partner. So, I want to go into this a little deeper. This model is, I'm sure it's been around for a while, but I have been hearing a ton about it recently. It's becoming, from what I understand, it seems like it's becoming more popular as larger operators are using this model.
Yeah, it's becoming super popular. It's funny because within our circles, it's we hear about it all the time, and it seems like it's saturated and like overkill. How many people are going out and doing like fund to funds, or these syndication deals where they're bringing in like 10 or 15 different fund managers to help fund their deal. But for the 99% of people, in the United States and across the world, this is a very new concept. Traditionally, owning large commercial real estate was only available to ultra high net worth and institutions. It was never really available to everyday people like you and me. But with all of these companies that are now essentially fractionalizing the ownership in these assets and selling them through specific SEC exemptions, now ownership in these commercial assets is available to literally everyone, and you don't even have to be accredited. So one of those exemptions to in SEC Regulation D is called 506B. And essentially, that allows these sponsors to take up to 35 non-accredited investors. What that means is that you're not worth $1 million and you're not making $200,000 a year if you're single, or 300 if you're married. And so, these people who are not ultra high net worth are able to invest in these deals. They have to be sophisticated, and they have to have a pre-existing relationship with the operator. So a phone call, a video call, whatever. But yeah, it's relatively new thing. When I got started with this 8 years ago, I had never really heard of it. There weren't, courses that people could pay $30,000 for and learn everything there is to know about syndicating and fractionalizing commercial real estate. It's a pretty new thing, and I think it's awesome. It's really making it more accessible for people and creating pathways for everyday people to generate significant wealth and passive income.
And just to clarify our terms, you've used the term fund of funds. I've heard other people call themselves capital raisers, equity partners. Are these all one and the same? Is fund of funds, the term to be using, or what are we calling this model?
Okay, so I'd say, okay, you've got the company that is actually like buying the real estate. Those are the syndicators. Those are the real estate private equity funds. Those are what we call sponsors. Those are all pretty much the same. Then you have capital raisers. Capital raisers can either be a member of the actual sponsor that's buying the property, or they can be a broker dealer who is just raising money and introducing capital in exchange for a fee, and that requires having a license. Or they have what's relatively new in this space, fund of fund managers, and that's what I am. And let me just explain in very simple terms for everyone. Essentially, what a fund of funds is doing is setting up a completely separate LLC away from the actual property, away from the deal, away from the sponsor of the deal. And that fund of fund manager is then raising money within their separate LLC for the purpose of buying ownership in the actual property owning LLC. And so the reason why this is important is because back a few years ago, it used to have the actual fund LLC, the actual property owning LLC, invite 10, 15, maybe 20 people into their management, and we call them co-GPs or co-general partners. And those people would just be essentially raising capital in exchange for fees. Well, the Securities and Exchange Commission says that that's illegal. That is called broker dealering. And if you don't have a license to do that, you've committed a crime. And so the way around that is to essentially have all those co-GPs or those capital raisers leave the actual company and set up their own LLCs. And then they raise capital within their own LLC, and then they just write one check into the deal. And the way they get compensated is because that large check, sometimes it's 5, 10, 15, $20 million instead of the typical $50,000 buy-in. That large $10 million check gets you a seat at the negotiating table. And so you can go to those sponsors or the people who are actually arranging the deal, and you can say, I see that you're giving everyone else who goes to you 50% of the profits at the end of the deal. I'm not cool with that. I want 90% or 80% of the profits. And I want, a 10% preferred return, which essentially means I don't want you to get compensated at all until I've made 10%. And so by doing that, it essentially gets the fund of fund manager a higher rate of return for his fund because he's negotiated better profit split with the sponsor. And the fund of fund manager can then charge fees to his own fund, and his investors will still end up better off than everyone else who went directly into the opportunity. Does that clear things up?
Absolutely. And so the benefit to the operator is, say they do have a significant raise, like in your example, a $20 million raise. That could, depending on the network, that could take a significant amount of time. It could take multiple webinars, email blasts, flying around the country to meet with investors, lots of stuff on the back end to raise a significant chunk of money. But someone like you comes in and says, "Hey, I can help you with that, and you don't have to do all that. You don't have to do all the webinars and flying around. I can bring a single check, if not for 20 million, maybe a good chunk of it,
right,
so that maybe I can bring 10 or 15, so that
exactly.
The fundraising responsibility of the operator is much less, so they can focus on the deal, and someone like you can bring in a significant chunk of the equity." Do I kind of have that right as the benefit
Absolutely.
to the operator?
I'll go do all the hard work of raising the money needed for the deal, along with other people who are doing the exact same thing. And then, we'll take all that money and we'll pool it all together into one company. We'll write you as the sponsor one check, and that will take a load off of your shoulders and allow you to get back to what you're good at, which is managing the deal. And in exchange, I want better terms. I want more of the profit at the end of the deal. And that should be okay with most sponsors. It is okay with most sponsors, but it is always a negotiation. So.
And it's all transparent. I get emails from fund to fund managers like yourself. I don't think I'm on your email list, so I'm going to have to get on your email list. But it's all, from what I've seen, it's transparent. So I've seen a fund manager, send out an email saying, hey, they're raising for Ashcroft Capital. Here's the property, here's the deal, here are the returns, and a webinar is scheduled for, X date. I think Rise 48 does the same thing. I've gotten emails for, fundraisers for Rise 48 doing the same thing. And so it's not opaque. It's not like, no, I have a secret deal sponsor that nobody else knows about. It's transparent. So when I see that email, I think, okay, well, why would I invest with Elijah? Why wouldn't I just go directly to Ashcroft or Rise 48? And is it exactly what you said? Because you're potentially bringing a larger check, their returns could potentially be higher going through a fund manager like yourself?
Right. So, and I raise for Rise 48 all the time. And so that specific situation, when I send out my emails, I'm putting Rise 48's logo right at the top. Like, I've partnered with Rise 48. I'm raising money for their deal. And the reason why it's better to invest in my pool rather than going directly into theirs is because if you write a $50,000 check for Rise 48, they're going to take 30% of the profits until you hit a 15% IRR, and then they'll take 50% of the profits after that, or whatever in the future they offer to their investors. Whereas for me, my fund is writing a larger check, and so I get a separate share class. I get a completely different deal. In the publicly traded mutual fund world, they call these like advisor shares, whereas essentially I'm getting a better deal on the fees in exchange for writing a bigger check. And so I'll get to keep 80% of the profits, at any level. I'm not giving away 50% of the profits to Rise 48. And so I can pass that benefit along to the investors within my pool. And so I'd say, really, if you're considering being a passive investor in any of these deals, it's probably, a better idea to invest through a fund-of-fund manager, because if the deal outperforms, you're going to do way better on your return rate because you're not giving away 50% of those profits.
Makes a lot of sense. And even when you invest directly with a sponsor, there are fees involved. There are acquisition fees and asset management fees and property management fees, all kinds of stuff. Should investors expect to have fees when they work with a capital raiser? How are you compensated?
Definitely. So the fees work the same way with me that they do with Rise 48 and the other sponsors. And in most situations, you're getting fees twice. You're essentially being double feed because you're being feed by the sponsor and you're being feed by the fund-of-fund manager. And same thing with like the profit split at the end of the deal. We call this the waterfall. You're being double waterfalled. So, Rise will make money in their deal. They'll give me 20%. They'll give me 80% of those profits, and then I'll turn around and take my fund profits and I'll give my investors 85% of that. Now, the net impact of all that is that the investors within my pool, they still end up better off than had they gone direct to Rise. So, the rate of return ends up being higher, especially if the deal outperforms. If they're going to go and, hit, a 50% IRR or so, they're in that 50% profit taking range, whereas I'm getting 80% of it. So it still ends up a way, way better deal for the investors when they go into the fund-to-fund manager rather than into the deal directly. The other thing I wanted to mention is we can make our own minimum buy-ins. We can set our own kind of rules and stuff like that. So, for a company like Rise, they're huge. They're doing $50,000 minimums. Same thing with like most companies. It's either $50,000 or $100,000. I'm offering my investors $25,000 buy-ins. So if you don't have the 50 to get, go direct to Rise, you come to me, you put in 25. Not only can you get into the opportunity, but now you're even getting a higher rate of return than everyone else who's going direct. So there's a lot of benefits. Typically, I'm raising a fund of funds for sponsors that I have a close relationship with, that I know very well. I can text the CEOs of these companies. I can get responses, very quickly. Within an hour or two on email. I know these people. I've sat down and had dinners with them multiple times. I know I like them. I trust them, and typically these sponsors are extremely wealthy themselves. Let me explain why that's important. So I only want to invest in, sponsors that are significantly wealthy, because when things go wrong in the deal, someone's going to have to lend the company money and bail the company out. Essentially, for example, let's say the loan is the interest rate is going way up and there's no interest rate cap, and the company is hemorrhaging cash flow, and then the roof goes out and you have to replace that, and essentially all the money's gone, and what are you going to do? You can't pay the mortgage. Well, a lot of sponsors will come to the investors and say, hey, you guys need to cough up more cash so that we can keep this company alive. Well, I want my sponsor to write a check first before they come to me. I want them to go try to save the day before they come and ask me. So that's an important thing as well.
Really important thing to point out. I think we're only probably at the beginning of some of the turmoil in the multifamily world, and I think we're going to see, kind of what you said with separating wealthy sponsors from newbie sponsors, and the newbie sponsors who have no net worth, who've done this tremendous deal, asking their LPs to put in more cash, whereas the more experienced, the wealthier sponsors are going to be a little more prepared for some of the potential turmoil that's to come. So I think that's a great point. It seems like when you invest in a deal, you're investing in individual deals. It's not a blind fund where you're constantly raising capital and you just invest in deals as they come up, and your investors don't have a say in where their money goes. You're raising on a deal by deal basis.
I do both. So
Okay.
This year I did a round for TechVestor with their Airbnb fund, and that's a blind pool. They're going out and they're buying 100 single family houses and converting them into Airbnbs, and nobody knows what the actual properties will be. Essentially you're buying into a strategy, and you're buying into the team and their track record, and it's a lot harder to raise capital for those types of opportunities. Investors, especially in this environment, they want to know the details. They want to see the underwriting model, the term sheet from the bank. They want to ask detailed questions about the properties. And when you can't identify those properties, it's difficult. I think it's every fund manager's dream to have a discretionary $500 million sitting in an account, where they can essentially go out and buy whatever they want with it. And, they have a fund mandate and a blind pool, and they can go out and invest that however they see fit. But to get to that level takes an extreme track record and a very large Rolodex of high net worth people who trust you and know you very closely. It's not an easy thing to do. So in the meantime, we go out and we do these single property or single identified, assets. It's just a lot easier to raise capital for those.
Tell me about the current dynamic between fund managers like you and operators. There's no question that it is more difficult to raise capital now than it was 2 years ago, for some of the reasons that you just mentioned. Are capital raisers trying to convince sponsors to allow them to raise money for the operator? Or are operators coming to capital raisers like you and trying to get you to raise capital for them because raising capital is so difficult? Can you talk about the current dynamic between yourself and operators right now?
Yeah, it's the second one for sure. Operators are coming to us and begging us to raise capital for them. It is an extremely challenging environment right now. People will always be scared, but there's a lot more fear in the markets right now than there was a year ago or 2 years ago. It's people are sitting on the sidelines right now, and they're saying, "Well, the market's crashing or about to crash. Like, I'm not going to invest now." But you know what? Once the market's on a bull run, they're going to say, "Oh, it's too expensive. I'm too late. I'm going to sit out." And so the advice I give to people is like, you need to just take a long-term approach to this. If you can get into the market for, more than 5 years, maybe like 10, 15, 20 years, just leave your money in. You don't have to worry so much about those near-term ups and downs. It's always a good time to buy. And right now is quite possibly the best time to buy that maybe you'll ever see. Right now we're scooping up, with Rise, we're buying an asset at, 20 to 30% below what it would have traded at a year ago. And we're looking to do that across a number of different operators this year. We're getting big discounts, but you know what hasn't gone away? The imbalance of supply and demand. We're like 5 million housing units short, and right now it's too expensive to build. So what does that mean? That means the problem's going to get worse. The demand for these housing units is just far outpacing the supply available. And once the interest rates stabilize and eventually come down, there's just going to be a boom, and all that institutional and private equity capital that is dry powder right now sitting on the sidelines in cash or whatever, that's going to be deployed. And when that happens, bidding wars start to happen and prices get driven up. I think, we're in for a massive bull market in 2025.
So, what are your standards for operators and deals? You talked about that operators really do need capital raisers right now. A lot of people are looking for capital. They're trying to do deals. They're looking for capital. So how does an operator get someone like Elijah Brown to raise capital for them?
So what I look for in operators, I want them to have a track record. So, maybe that's 5 or 10 full cycle exits on properties. I want to see them beating their projections. There's a big plus if they've been investing during a down cycle like in 2008, but that's obviously quite rare to find those anymore. They exist, but they're like a lot bigger. And so companies like Rise, they've only been advertising, not advertising, they've only been like pitching these deals for like 3 years, but they have 11 full cycle exits at like a 70% IRR in like an 18-month time frame on average. And so that track record is significant. That tells me that the sponsor knows what they're doing. They're good at executing on their business plan. They're regularly, or every single time, they're outperforming the projections. I like that. The other thing, I want to make sure that their underwriting is conservative enough. So I'll ask for their model because I have a background in cash flow modeling. I want to see how they're understanding and analyzing the risk, and if it's conservative. I want to have a personal relationship with that sponsor. I need to trust them essentially. So I'll have in-person meetings with them. I'll, call them on the phone or whatever, but I want to have those multiple touch points before I decide to invest in their deals.
Sure. Yep. That'll make sense. What sets apart great operators? We're kind of in a tough time right now. And so from the sponsors and operators that you're working with, what is setting apart the great operators right now?
Communication, for sure. When the sponsor is not communicating enough with the investors get worried, and the investors start to doubt. And the sponsors that are sending out their monthly emails, and then also checking in other ways as well, putting out content and checking in with the investors, that adds a ton of credibility and trust, and really helps, it helps me and it helps the other investors feel more comfortable and confident in the actual investment and in the sponsor. When someone's not talking and they're not communicating, it usually means that something's maybe not right.
And even if everything is okay, it's just human nature to think no news is bad news. I haven't
Right.
heard anything. And so just as humans, our minds start wandering. I haven't heard anything. So, there
Right.
must have been a fire. Wasn't there a hurricane that just went through? Or maybe, there's a downturn. People aren't paying rent. And so then, investors' minds just wander. And so when
One
they don't hear
example of
anything.
this that I would like to share. So, like, a lot of sponsors right now are going to their investors and they're saying we need more money because they got into trouble with the loan. So Rise 48, Zach Hoppenstall, he's awesome. He, put together a whole like webinar and like a live of like an actual like event, and then sent out emails pretty much explaining to literally like all of his investors that, they're not going to be doing that. Here's why they're not doing that. Here are the preparations that they've made and what they're doing going forward so that they will never have to do that. And that's just huge. Like, everything's going great within his portfolios, and he's still, communicating with everyone because there are other fears in the market going on. So that's just an example.
Yep, that's a great example. Things are going great, communicate it. Things are going
Right.
not very well, communicate it.
Right.
If there's a hiccup or a bump in the road, just communicate it. A lot of times, people are understanding as long as they know and they're
Yeah,
updated.
absolutely.
Elijah, can we go into some capital raising tips?
Sure.
Let's say, give me 3 capital raising tips, and then we can go a little deeper into each one.
Sure. I'll start with, so I spent my first 6 years just working with friends and family, and coworkers essentially. So I'd say like when you don't have a track record, and you don't have much experience, start with the people who are going to trust you no matter what. And that's friends and family. Essentially, you got to start with friends and family in the beginning. So that's, tip number 1 is just like write down a list of literally everyone go on Facebook, make a post, say, I'm a real estate investor now, I'm looking to buy properties, who's interested. Put together a list of literally everyone and reach out to them and have conversations with them, tell them what you're doing. So that's number 1. At some point, and it happened to me, you exhaust your list of friends and family. You can't raise $10 million from the same people over and over again. And so you need to start, doing some type of thought leadership for lead generation. And I do that through LinkedIn and through podcasts. And I'm actually preparing to do some TikTok videos as well, because I've heard that goes well. So I'm, putting out content multiple times a week, with the main call to action of like sign up for my email list so that you can get my deals and that you can get educated essentially. So thought leadership, that's really number 2. And then number 3 is nurturing your leads. So once you've heard from someone that they're remotely interested in investing in real estate, or they've given you their email address or their phone number, their contact, whatever, they're not going to invest right away. Usually it takes people watching 3, 4, 5 deals go by before they even get in. It could be 3 or 4 years before they even decide to invest. Maybe they don't have the capital at the time, but then they inherit $1 million in a few years and they're ready, and they've been getting your emails or watching you online, and they know you, they like your content, and maybe they'll trust you. So what I do is, as soon as people come into my email system, I send them a weekly email with some type of educational tip or like real estate related advice, to try to get them up to speed on essentially what is investing in real estate, how can you do it better, and how I do it, how my company operates. And that goes for almost a year of those emails. And then at some point I send them a deal, maybe it's 6 or 12 months down the line, and they say, wow, this guy's, I recognize his face, it's been all over the emails, and he's been giving me great advice and essentially teaching me how this all works. I trust him, I'm going to invest some money with him. And that's how it works. It's really all about the nurturing. So
Great.
that's it.
Yeah, three great tips. Number one, start with friends and family, coworkers, people that already know you and trust you. Make a list of those people and start there. Number two, develop some sort of thought leadership platform, whether it's being a guest on podcasts, starting your own podcast, LinkedIn posts, and then developing an email list, getting those LinkedIn leads going to your email list, and then finally nurturing your leads through that email list, and continuously, talking to people so that, something that a piece of advice that I've heard is don't let the only time people hear from you is when you're asking for something. And
Right.
so if you're continuously talking with people and it's a conversation, it's, teaching people about multifamily, teaching people about underwriting, how to ask questions of operators when you're looking at investing in a deal, and then maybe every month or every quarter, then there's a deal, so
Right.
that people feel like there's already a relationship there. Did I sum those up okay for you?
Absolutely. We've recently started integrating texting as well within these. So sometimes I'll shoot these investors a personal text message. It is automated, but it is actually like me and my number. And if you text back, then we can have a conversation. So,
Yeah, I mean, I know Brandon Turner famously has a
yeah.
text newsletter, and I think that's a great strategy, because, man, I've learned that different people just communicate in different ways. Some people hate texting and they don't ever check their texts, and they don't respond, or they only respond or check once a week. Some people don't check emails and they don't like emails. Some people only communicate through Facebook messaging.
Right.
And so I think that's a really, really smart idea to have multiple modes of communication. What kind of software, or cloud-based systems are you using? Are you using ConvertKit or Mailchimp, or what have you found that works for you?
Yeah, I'm actually going to give you some free chicken here, and I've got a list of like all of the like the software apps that I use to run my business. So I'm just going to give you some of them. So
Great.
yeah, so within the thought leadership realm, I'm using a software called Publer, Publr, to schedule out my LinkedIn posts. So I'll spend one day a month essentially drafting posts and then scheduling them through that Publer software. Sometimes I'm using ChatGPT to help me, come up with ideas or to refine things. I also use ChatGPT for, helping me with like side letter legal agreements or asking just general questions on complicated topics. And then so LinkedIn for sure. I have an Instagram, don't really use it much. And then for my email marketing software, I use ActiveCampaign, and I think most people within this industry are using ActiveCampaign. It's great, and I use that for all my email lists. I've got a few digital knowledge products up on my website, like an example deal, an ebook, and an Excel model. And when people fill those forms out to get those free products, they get entered into my email system, and then the email system sends them those products and also signs them up for my educational content. Yeah, go ahead.
Oh no, I was just going to add that those links will definitely be in the show notes. I think it's great that you're adding value to potential investors and listeners. That you're not just asking people to invest with you, but start with value and provide value to people, and then eventually it comes back to you.
I'm a huge believer in that. Just like provide tremendous amount of value without the expectation of getting anything in return, and usually that ends up paying off dividends. So, well, let me give you a few more. So I use Calendly for my scheduling of meetings, and I set like a very narrow window of when I take meetings, and I'm very kind of like strict with that calendar for my own time management, especially as a digital nomad when I'm traveling so much. And for my meetings, I use Zoom. We use Loom, which is essentially allows you to like screen record your computer. It also allows you to have your face on there as well, and you can do instructional tutorial things, or you can even just record a short video for investors and then send that to them as well. Within our actual deal management realm, we're using software called InvestNext, and that's where we post our deals on the portal. It allows investors to subscribe to those deals, e-sign documents, wire funds, and then also receive updates and distributions, all done within that portal. So that's an incredible deal management tool that we use. That's pretty much it. We're experimenting with a few others like Fireflies. That's essentially an AI tool that records and transcribes and summarizes conversations that you have with anyone, and then it'll add those summaries automatically to our active campaign notes for a contact, so we can essentially keep all the information on who we're talking to. But that's pretty much it. That's our full tech stack. It's actually pretty light. We probably spend like $5,000 a year on all the subscriptions, and that's what it is.
Perfect. Elijah, we've got a few minutes left. You touched on your digital nomad setup. I talked about it in the intro a little bit, living out of a van. And you talked about being currently in Colorado. I think I heard you on a podcast at one point. I think you were at the Baja Peninsula of Mexico.
Yeah.
So that really caught my attention. So describe your current living setup and what was the inspiration for it?
Yeah, it's like 5 years ago, I had this dream of like getting a school bus and like converting it into essentially a home on wheels, like an RV, and then traveling the world. So my girlfriend and I, we ended up getting a Mercedes Sprinter van for a lot of different reasons. You can park it in a parking spot, and the resale value is a lot higher. It's just a nice vehicle. We spent 2 years building it out, and then we went down to Mexico. We hung out there for a while. We've been making our way around the country. Right now we're in Colorado, so we're 45 minutes outside of Telluride, just really enjoying it. We found a small town that we really, really like, and we're just going to be here for a little while, enjoying the summer. And we're currently at a WeWork space. Well, not WeWork. It's a different company co-working space, but it's kind of difficult when you're in such a small space to both be like, my girlfriend and I both have our own businesses. And so we're both on the phone like all day and taking meetings in such a small space. And so it really helps to be able to go to a co-working space for the day and kind of have my own essentially my own office here that I can get my work done in.
What town are you in?
We're in Uray County. I'm not going to say the exact town.
Sure. Yeah. I live in Cheyenne, Wyoming. I've traveled around Colorado quite a bit. Telluride is one of my favorite towns. Uray is probably even more beautiful than Telluride, but super remote, brutal winters.
The Switzerland of America.
Yeah. San Juan Mountains are just gorgeous, and
it's incredible.
It's an awesome place to be. So tell me about the logistics of it. So you've talked about kind of getting into a co-working space. I imagine co-working spaces on the Baja Peninsula are not abundant. And so my mind goes to like, what do you do for internet and phone service and dealing with time zones and just trying to run a business, but you also, you want to have this rustic lifestyle, but you also, sort of need the modern conveniences of life. So how do you manage that part?
Starlink satellite. So we bought a Starlink. It's like $650 for the hardware and then $150 a month for the service. And that provides us with internet pretty much anywhere that we've been, at least. And so that takes care of our internet. I use a Google Voice phone number, so that works with that. But I use Verizon for my phone, and when I'm international, I add on an international plan to my phone, and that allows me to get service there as well. But that's pretty much it. When we're traveling, we're both either working inside the van or one of us is working outside the van. We've got a table and chairs and an awning, and so that's pretty much what we do. We'll roll right up to a river or a beach, and we'll just set up a table and chairs.
And so the Starlink internet, is that Is that literally a satellite dish that you
Oh
have to
yeah,
place on your van, or is it like a
yeah.
USB thumb drive, or what does it
No,
look like?
it's a satellite dish.
Okay.
It's like a rectangular dish, and it comes with like a stand that I put some magnets on, and I just throw it on top of the roof and or outside, and it's like lightning fast internet anywhere I want.
Wow, great tip.
Yeah.
Um, I'm sure it's not all sunshine, rainbows, and unicorns. What are some of the drawbacks to
Yeah.
your way of life right now?
You lose about half a day every single week from dumping tanks, filling up tanks, getting fuel, doing laundry, like all the chores, moving locations. There's just a lot of kind of maintenance type of stuff that you lose a lot of time doing. It's also difficult, trying to run two businesses within such a small space, especially like we have to sync our calendars together so that we're not stepping on each other's meetings. And then just not knowing sometimes where you're going to be or sleep that night. It's like I've got investor meetings scheduled all week, but not knowing if I'm going to have a safe, quiet place to take those calls can be a little challenging. So that's it. Really, other than that, we really love it. We're having a great time. We're getting to see the world and just essentially being out in nature.
What's your advice to other people who have this idyllic mindset of working in the Caribbean or Hawaii or Europe and traveling around, but are having a hard time sort of conceptualizing? Well, I've got maybe a house or a pet or a business, or what's your advice to people?
Yeah, it's not as hard as you think it is. Even if you have responsibilities, we see families on the road with school buses all the time, and they're just making it work. They're homeschooling. They're doing everything they need to. They're setting up play dates, social time with other travelers in the area, and stuff like that. It's not that bad. If you've got a lot of responsibilities, it feels really good to kind of remove yourself from a lot of that. Sell a lot of your extra crap that you've got. Put it in a storage unit or something. Grab the kids and just go for a few months. It's incredible. It's not that difficult. You'll realize that you know. Incredible experiences and memories are just on the other side of your fear.
Yeah, love that. That's a great spot to end it. Elijah, I sincerely appreciate your generosity of time and knowledge today. If people want to connect with you, where do you want to send them?
LinkedIn is the best. So go to LinkedIn. Hopefully we can put the description down below. It's linkedin.com/in/Elijah W. Brown. Shoot me a connect and you can see all the free links on there. And usually in my posts, I'll put a link to signing up for my deal and educational list as well. You can also check us out on GoldHawk.us, which is our website. And we've got a lot of good, valuable content there as well.
Perfect. Elijah, thank you so much for joining me here today. Listeners, I hope you found value in today's conversation. If so, be sure to connect with us on LinkedIn and our website. Hit subscribe wherever you're listening to this or watching this. I appreciate you. Until next time, take care.